Hey everyone, welcome to another Market Radar podcast. Hope you've had an exciting week like we have. It's been pretty hectic in the markets this past week. Next week is not going to be any easier. We've got FOMC on Wednesday. That's going to be the main thing we're going to be looking for. And then, of course, Thursday we have the Fed balance sheet. Everyone's wondering where that's going to go now that everyone thinks they're doing QE, which they're not, by the way. What they have done with the banks is not QE. It's completely different, but everyone wants to see where their balance sheet's going, and so that's also going to be important on Thursday. Let's take a look at what the Nasdaq did this past week. We pretty much started the week off at the lows, ended the week off much higher. So it's been a good week to say the least. For us at least, we have been long Nasdaq for about a month and a half now since we got our Riskon trigger. And important thing to note is our portfolio allocation portfolio allocation has shifted this past week. We did make some adjustments, and our system remains risk on. However, the confidence score is lower, much lower actually, than the start of the week. So we'll see where that goes. But at the end of the day, risk on is risk on, whether or not it's confident or not. So Gamma, what do you have to say about the current risk on with low confidence? What can we expect going forward?
Right. So let's clarify the risk ons for those that don't understand. So we have at Market Radar, we have our tools. Now our tools are the system and DDAP. Those are our two main tools that we use. And the system is our economic regime tool. So it's how we price out market regimes based on market pricing and a bunch of indicators and economic data combined, and we have the output regimes which we focus on. Then there's DDAP, which is the market trend tool, which is measuring trends within the market. It's what you see on here on TradingView. It's the bullish bearish trends with the backgrounds red and green, and the MOMO being the momentum line in orange. So we combine these two tools, and when we combine these two tools, we generate our models. One of our models is Aries. That's our leveraged tactical bond and equity model. Now, when we are focused on the model can shift positioning as it did into the end of this week, but the regime can remain the same, meaning we can still stay in risk on, even if it's a low confidence, but our model shifted out. It didn't see the upside that it would like to see to stay long. So it made some adjustments into the end of the week. Now, in terms of what can still happen in risk on, one of the things is Bitcoin can still go higher, dollar can still go lower, euro can still go higher, bonds can still chop, and equities can still go higher.
Also to add to that, bonds could also go higher. Just because it's risk on doesn't mean bonds cannot go higher. So that's right. That's something to pay attention to as well.
Yeah. So there's a reason why, if for those that aren't familiar, we have this current theory that's floating around. It's called the trade of lost souls, TOLS, tolls. So what the trade of lost souls is the idea that a lot of people are going to get caught offsides in this risk on environment because they can't believe it can happen, right? Like the idea of a risk on environment with banks collapsing, you say it out loud, you sound like an idiot, but in reality, it's not something we're making up. Remember, you can call trade of lost souls our narrative, but it's not really our narrative because it can evaporate any day. But it's built around the data that we're seeing within those tools that I explained earlier. So those tools are driving these messages that we're giving you. So the trade of lost souls isn't something that I just thought about one day and was like, oh yeah, like this is going to happen because the banks are going to fail. It's not like that. It's the trade of lost souls is constructed after me looking through the entire system and all the DDAP trends and me compiling the most likely outcome from what I'm seeing at this point in time. So bonds can go higher and they can chop. There's a reason we say bonds chop and not bonds down, because the risk for bonds to go lower, or I should say the downside probability in bonds is not where it was 6 months ago. It just isn't. And that's showing up within our tools. And obviously that's helping us formulate the trade of lost souls. Now, the trade of lost souls is also going to be a very interesting. It's going to be a very interesting play to watch, because for it to play out, we're going to have to stay in risk on. If risk on pivots, the trade of lost souls is dead. It's rather simple. It's okay. No longer. It depends what happened. Did we get it right? Did we get it wrong? We'll see what happens when that trade or when that theory evaporates. But as of right now, it's still in full effect. Now, you can take a look here at the dollar. The dollar has been bearish DDAP trend, right? DDAP being one of our tools, since November of 2022. So this has been pretty much in bearish trend. Now, this is not something that you see in risk on environments. In risk off environments, this is a risk on signal. Okay, it's a confirmatory signal. It's not the signal for risk on, but it's something that you see in risk on environments. Now, the dollar has had trouble breaking higher after the March rally, and now we are going lower. And in turn, euro is bouncing. A lot of other dollar components are moving up as well. Yen, pound, all pretty much moving up and edging higher.
Simply because they have more hiking to do than the Fed does.
Right. So if we take a look at the Fed forecaster, you can see here that we are approaching the terminal rather quickly after this whole fiasco. And we'll talk more about that with what the FOMC is, what we're seeing with the FOMC and whatnot. But you can see that we're already looking at rate cuts into the second half of this year, where the ECB doesn't seem to have the same grasp on inflation, meaning they may have to hike more. And the forwards going out 6 months from now are a lot closer than they were 3 months ago on the dollar to ECB, on the dollar to euro, meaning the gap between the ECB and Fed is closing. In turn, euro is going to gain some favor in that scenario. And this is just all what we're seeing based on the current risk on environment. Trade of lost souls is built around this. That's the trade of lost souls. People believe that euro is dead, right? Everyone's saying, "Oh, euro is going to break down, going to go whatever, go under parity and break lower." We do think over the long term, euro is pretty much in a really tough position to succeed, just due to the dynamics of what the currency represents. But that's a narrative. Remember, throw the narratives aside. What's happening right now is more important. Euro can go higher as long as the trade of lost souls is in effect. Now, let's go into what happened in the last week as when we talk about FOMC. So FOMC is next week, is on Wednesday. We're going to get the policy decision. We're going to get some forward guidance. And we're going to get some dot plots from the Fed. That's really what the market is going to be looking for. The last dot plots from the Fed were in December, and they were showing us a 500, 520, or 515-ish terminal, 500 basis points being 515 basis point terminal. We'll see where that gets revised to next on Wednesday. Now, the expected move from the Fed on our side is we think they're going to do 25 basis points. We've been saying 25 basis points the whole week, this week, last week, and for a while now. The market
it's kind of a no-brainer, right? The
yeah.
market's now pricing in cuts pretty soon here, expecting deflation and a reason for the Fed to cut. What do you think about that?
I think it's such a weird dynamic, because the market is the market's trying to figure out if we're going to get a recession or not. That's what's going on, and you can see that in the Fed funds curve going out, as we saw here. As we go out, like this is more this is more supportive to or easing to the economy than anything else. And we don't know if we don't believe the recession is going to hit yet, but we have to watch the system to guide us, right? But as of right now, risk on is obviously not a recession. So if this comes into play, what it's going to do is it's going to ease financial conditions and do a lot of things for the market that the market does like. Now, there's this other narrative that's floating around, and we keep saying this. It's the impossible soft landing, and it's very important that you understand what that actually means. Unemployment is still under 4%. So if the Fed starts basically rolling over now, and you're going to get the assumption that the Fed believes inflation is under control. They've controlled inflation without killing the labor market, which is exactly what the soft landing is. And I think that is why we saw this type of move on the NASDAQ. Everyone says, oh, the rates are, the idea of lower rates, front end of the curve fell. and we saw that with the 2s and 10 spread. We'll go over that in a little bit on what's been going on in the bond market, the excessive volatility, what it's from. But as of right now, NASDAQ moved off the lows aggressively. Large cap tech, you're talking large cap growth, right? The idea that growth could be sustained if the Fed starts easing, and obviously market shot up now. Whereas the Russell, on the other hand, well, that pretty much got toasted due to the banking exposure. So NASDAQ has very minimal, pretty much no banking exposure, which is why it's been so resilient. And you can really see that the current conditions in the market that are generating this volatility and this uncertainty are behind the banking sector. It's not the large caps that are causing the problem here. It's the banks.
Yeah, and it seems very contained within that sector as well. It's not really affecting any other sectors.
Yeah, not yet, right? We have to see where it goes. But yeah, you're right, 100%. You can just see it. You can just see that, the NASDAQ almost strided up, pulled the week in a solid stride here, while the markets were almost getting way down every day. Like, you can even look at ES. Look at this. It struggled to push higher. It couldn't even close above Monday's high this week. Whereas NASDAQ, on the other hand, we're talking, we closed 345 basis points above Monday's high. So again, huge relative strength here in the NASDAQ. Yeah. And again, that's the banking issues that aren't the NASDAQ isn't exposed to, at least directly.
So going back to the Fed forecaster, the cuts are pricing in, the futures are pricing in about a 1% cut, and then that's it. Is that really realistic? If there really is a recession, why would they only cut 1% and hold? Or is that a sign of the futures market also expecting a soft landing? They pull back rates a little bit and then they can hold, and then maybe pull back rates a little bit more later down the line and just kind of progress towards that soft landing.
Right. Yeah, I think that's a spot on way to look at it. And I think the most comparable period in history that we can go back to, taking inflation out of the equation. If we forget about inflation, the rate of inflation right now, it being 6% or whatnot. Look at 2018, 19. This gradual drop. We went from 238 basis points to we dropped like one rate cut, right? One rate. This gradual slow drop, and then obviously this was you can call 2020 recession. I mean, this was really like a mini depression. The way that everything got crushed. But it was a steady walk down on rates. And could the market think that we're going to get an environment like this? Maybe. That's why the Fed funds forecaster that we have here is pulling the forward. It's based on the futures. The futures are pulling rate expectations down in the future, and the idea that the Fed is going to need to ease. And obviously, this was greatly accelerated by the banking crisis we experienced last weekend. If it wasn't for that banking crisis, this wouldn't be going on right now.
Right. And now they're seeing a reason to cut. Before, there was no reasons to cut.
Right. And if we take a look at the 2s and 10 spread, we went over this last week. We spoke about what this is. Then this going bullish trend would be the early sign. It's not the sign. We want to see the reversion, right? Because remember, yield curve inversions don't mean much. It's the reversions, when they revert out of the yield curve, that things become problematic. And we're seeing we had this steep inversion here, and now we're starting to see it revert towards zero. Now, what's going to have to happen for it to get to zero? It's pretty much going to have to go bullish trend here. So that would be the first sign. If you see bullish trend, okay, you can now assume there is higher probability of a leg higher to zero. So what is this telling you, though? Let's break this down. What are the 2s and 10s telling you, and why are they up so much in the past 2 weeks? Well, what it's telling you is the long end of the yield curve is basically falling at a slower rate than the front end of the yield curve. So what's going on is the expectation of the Fed cuts, because remember, the Fed really control the entire yield curve to a degree, but they have the most control, or the best control, over short-term rates, 2 years and under. So this being a 10-year minus 2 year, we're looking at the 10-year minus the 2 year yield, getting the spread. It's negative right now, meaning the 10-year is lower than the 2 year. But what ended up happening was, when this whole banking thing unfolded, as you can see here, it literally started on Thursday of last week and Friday, and then over the weekend with the whole crisis, it gapped up and squeezed. And what this is telling you is expectations for the Fed to cut rates are rising. They're much higher than they were a week ago. Obviously, you can see that in the Fed forecaster. This did not look like this last week. And this is primarily due to the fact that people are unsure about the whole banking situation, how it's going to play out. And we had some interesting events develop last weekend. So we recorded the podcast before any of the news was released in regarding the BTFP, which is the emergency lending program by the Fed to backstop the regional banks. That all came out after we recorded the podcast. So I think I'll go over that right now, just to sum up what really happened. Basically, what the Fed did was they opened an emergency facility that allowed regional banks that are underwater on their hold to maturity debt. They can basically loan that debt to the bank or to the Federal Reserve, and at a face value. So let's just say they bought it at 100, par is 100, but face value is 60, right? They can lend that $60 worth of treasuries to the Fed, and they'll swap it back for 100. They'll get face value for it. So it's basically like exchanging something that is at a loss but getting full value for it. That's really what they did. This is the emergency lending program. Now, the issue is this whole concern about it being QE and not QE. And I think that the market is taking it to a degree that it is QE. In a way, you can make the argument that it's QE, but it's not QE if you understand the whole dynamic of what quantitative easing is, right? Like, it's not just the balance sheet going up, because the Fed can offset this. So the Fed's been letting, and the reason the balance sheet went up, simply put, is that collateral that's getting swapped, that's getting traded for, or getting lent to the Fed for money, that has to go somewhere. Those are treasuries, whatever they are, right? Whatever type, MBSs, whatever they are, right? Whatever's being swapped, going to the Fed, it has to sit somewhere. If it's treasuries, MBS, any of that, it has to sit somewhere. So where it sits is the Fed balance sheet. So that's collateral the Fed's collected, pretty much, and that's showing up on their balance sheet.
Right, and it's a lot more temporary, right? Like that.
Right.
That balance sheet increase can reverse once all this blows over.
Well, yeah, to a degree, all the Fed has to do to offset it. If their goal is to lower the balance sheet, all they have to do is let more securities mature off the balance sheet without rebuying. Because remember, the Fed is actually still purchasing securities every month, or as the securities mature, right? So as securities roll off the balance sheet, if the Fed didn't do anything, that balance sheet deceleration would be much faster. But the Fed is still going out there purchasing. They're just letting a piece of the balance sheet every month or every purchase period roll off, and they're just buying less than what's being matured. So the balance sheet's rolling down. So now we have this big influx into the balance sheet. I wouldn't be surprised, and we're going to see this on Wednesday, if Powell pokes at the idea of letting more maturities roll, or letting more assets roll off the balance sheet, and being basically less proactive to keep that balance sheet stable, bringing it down some more in light of these recent events and the drop of collateral from these regional banks. Now, Powell's going to have a pretty interesting press conference on Wednesday. He's going to be battling a few things. He's going to be battling the idea or the fear from reporters and journalists around the banking sector being safe. That's one. I would almost bet I would almost give a 100% chance he's going to get a question about the regional banking system and are the banks safe. The next one would be, I would almost also guarantee that he's going to get a question asking if the Fed is doing some sort of, if this is QE. Because everyone believes, or everyone wants to believe that it is QE. The idea is the Fed has pivoted, it's over, no rate hikes. There's even some people calling for rate cuts at this next meeting. However, we've been looking at 25 basis points for a while now. Pretty much since the last Fed meeting, we've come out and said that it's most likely going to be 25 basis point increments. And the reason being is you have to take a step back, right? The Federal Reserve is a board. It's comprised of a board of people that make votes. They don't sit there in front of a Bloomberg terminal and look at the Fed funds rates and say, Fed funds futures and say, oh, looks like we can do 25. Oh no, it's gone, man. We can only do. We can't hike.
We missed it.
Yeah, we missed it. Like, that's not how this works. Okay, the Fed funds futures are looking to price in what the Fed is doing, similar to the 2-year yield. So if we go back to the Fed funds futures here real quick, it's very interesting. I see this all the time, and it's kind of a joke in my opinion. I don't know how people really take this seriously, but I'm going to. I know why people take it seriously, because they end up. There's a lot of nonsense floating around on the internet. So if you take a look here, what you'll notice is that the effective federal funds rate by the Fed in orange, this is the orange line, and in white we have the 2-year yield. And they say, this is what they like to say, the 2-year controls the Fed. It's the other way around. The Fed controls the 2-year. And what most people don't get is the 2-year is operating in anticipation of the Fed. The Fed is not looking at the 2-year saying, for example, if we take a look at the 2-year, the Fed funds rate is 4.58, the 2-year is 4.16. They're saying, oh, rate hikes are done. The same people were saying the same thing here, and the Fed raised the rates 25 basis points. So the Fed's already proved this theory wrong, but it doesn't matter. That people cannot seem to lose the grasp that, or let go of the idea that the 2-year controls the Fed. Because if we go back to 2022, 2021 area where the Fed was pretty much at zero, right? The 2-year started accelerating.
Yeah,
why did the 2-year start accelerating?
I think people don't grasp it because they look at these two charts and yeah, that's what it looks like. It's a leading indicator. But they don't look at inflation with these. And looking at inflation
what we can do.
Let's go back part of this.
Yeah. Look at 2008. Look at the 2-year. It was literally under the Fed funds rate for, this was a year and a half here. A year? The 2-year was going. And then finally something broke. The Fed cut. And that's when the 2-year really dove. But the 2-year was saying that the 2-year was believing that the Fed was going to cut at some point in the near future. And sure enough, the Fed did. That's what this is pricing in. The 2-year has uncertainty around future Fed policy path. And what we saw last week, literally in the last 7 days, or I think 8 days, however you count it, we went from pricing in a 50 basis point rate hike to a 0 basis point, basically a pause, to a 25 basis point rate hike. So that's extreme volatility within 5 days. 8 days within that period of time, the market did not know if the Fed was going to, because remember, the last rate hike was 25 basis points. Okay. So when you're pricing in 50 basis points on a federal, on a policy decision, just think about where you're coming from. The Fed has slowed their policy down to 25s. Why did they do that? Why didn't they do 50 basis points the last meeting? Because they are getting to the point where they've said this. They've done a lot of the front loading. The 50 basis point moves were front loading policy. That was getting ahead. That was basically catching up to inflation because they were so far behind. Now they did 20. The last meeting they did 25 basis points, and what that did was it wasn't just one 25 basis point meeting. It showed the market across the curve, across duration, that the Fed was slowing towards the terminal. If they go to 50 basis points next week, they could. We don't know. I doubt they will. If they go to 50 basis points, the problem is, given the current conditions, they're going to throw stress across the whole curve, across the market, thinking there's a policy reacceleration underway. And what the Fed's going to immediately have to do, if they do 50 basis points, I would bet if they did 50 basis points, they would immediately have to leak the next Fed meeting, the next policy decision at the Fed meeting. At the next Fed meeting, because
to show that this is not something that they're going to do again.
Yeah, literally. I don't think they're doing 50 basis points anyways. I have a feeling it's 25.
Well, do you think they're going to be hawkish?
No. See, that's a good point. I think they're gonna pull a 25 basis point hike, hit the presser dovish, and basically say they're going to support regional banks. The backstops are in place, and basically allude that they will do whatever it takes to save the regional banks. In terms of like if a liquidity crunch occurs again, the Fed's backstopping. The Fed's going to be putting the brakes on the liquidity crisis. I think that's where he's going to go with it. But I'm almost certain these reporters are going to run him up amok with this QE nonsense about asking him like, is this going to continue? The whole thing around the Fed balance sheet erasing a lot of the recent decline. We erased like 3 or 4 months of this balance sheet roll off in 1 week. So Powell's going to be faced with the question of, if this continues, we'll be at balance sheet new all-time highs rather quickly. And again, it's a perception issue here.
Well, I mean, if we get what was that? A report, Wall Street Journal came out and said there's about 158 or so other banks that are in the same position as SVB was. If all of those banks fail, we would be at all-time highs on a balance sheet perspective.
Yeah, at that point, you would be, and I think the Fed would have to. That's where things become tricky. And let's actually talk about that. Given like our outlook on the Fed, what do we think? So let's take a look. This is inflation. Last report, 6%. This is right. I don't know why the Fed balance sheet's not there. Maybe it gets updated this weekend, but regardless. So we're at 6%. Now, the Fed is at 4.58%. They're here. I think that they're going to try and get their policy at or above inflation. Now, the next inflation print is expected to be in the fives, in the low fives somewhere, mid to low fives. The last dot plot from the Fed had a terminal 500, roughly 515, 500 basis points. Now, if the Fed does another hike, maybe 225s in a row, inflation that's in the next quarter will be under the Fed funds rate. Then they can hold. Unless something breaks in between. Now, you may say, oh, the banking crisis was that break. That wasn't the credit event. That was basically a race. You had a potential credit event on Friday, and by Sunday night, you had basically credit event of recession avoided, however you want to put it, credit event avoided by the Fed. Mm-hmm. So that was pretty much, that's all erased.
Yep.
You do, however, have some banks that are in a pretty poor position that may go under in the process, depending if they can get the collateral and if they qualify or whatnot, and they can work their way into this Fed liquidity injection. If they can't, they will go under, or if they realize their losses before they had the opportunity to basically borrow from the Fed. That one being SVB, obviously the main one. That this whole BTFP, the emergency lending program, didn't come out until SVB went defunct. So they were basically at the lock in the losses. They couldn't do the swap, so they got screwed here. And there's probably a bunch of other banks to a certain degree that are under pressure that may have locked in losses that we don't know about yet, and we're going to find out. But in terms of the core banks of the country, some will argue the regionals are important. They definitely are. But in terms of like actual liquidity, like the big banks, like the ones that cost 2008, they're okay. JP Morgan, Bank of America, Goldman, they're not going belly up. This is not the Lehman moment, is what I'm trying to say.
Yeah.
So in that case, I do think the Fed is going to come across. They're going to come across hike 25, sit there, talk more dovishly, maybe not a total dove, but talk more dovishly than usual, obviously, to kind of get the market in understanding that this is Powell's going to basically describe to the market that, in my opinion, that policy hikes are coming to an end. He's not going to say they are, but they're getting to that point where they're going to use a lot more data dependent, meeting by meeting. Maybe they're going to use a lot more of saying that they're watching the rate of inflation very closely now. And maybe even say that the Fed thinks a lot. They could say something like the Fed, like we think we've done most of the work, or most of the work's already done here, meaning they just insinuating that they are pretty much close to that end point where they will be able to pause. And obviously, if something emerges, they're going to start cutting.
Right.
But
and they're going to have to be pretty dovish about the whole banking situation. They don't want people to run to the bank and take their money out.
Right.
Imagine if he comes out hawkish about that situation.
I wouldn't be surprised in that. I'm sorry, what'd you say?
I just said, imagine if he comes out hawkish about that situation. That's just going to make this situation way worse. He has no reason to do that.
Oh, no, 100% no. I mean, I wouldn't even be surprised if we see some guidance from the Treasury and FDIC in the next couple of weeks here, raising the FDIC insurance limit from 250,000. That would be the next move. I mean, that, you raise that limit up, you prevent a lot of large denominated accounts from leaving smaller banks in the fear that if the default or if an insolvency or a liquidity crisis happens, they won't be able, their money won't be insured. But we'll see. That's more speculative, and that's not really around the Fed. The Fed, I think, is going to be 25 basis points. Talk dovishly and navigate through that presser with all these questions. And let's wrap up the podcast with volatility. Very important here. So we have 23. I've been tweeting about 23 the last couple of days. That is Momo on VIX. Above 23, hold and above, things get iffy. Okay, I said this. Below 23, things get stiffy for the bulls. If we hold and launch here, risk on can go risk off real quick.
Right, especially at the current strength that it's at.
Yeah.
It's fairly low confidence right now in risk on.
Yeah. Now, if we get back below, that might be what the bulls need here, specifically on ES, Russell, a lot of these things that are down heavy, volatilities across these indexes. Obviously, VIX is ES, right? Volatility across Russell is obviously going to be more elevated than even ES. Now, if we can get some type of reversal in volatility, it's just some vol compression. What's going to happen is as vol compresses and the market stabilize on the idea that there is no recession, you will likely get a further inversion, or I should say re-inversion of the yield curve going more negative, and the idea that the Fed may have to hold longer than what's being priced in already, because right now we're not even pricing in one meeting of holding. So the odds are pretty bearish here, or in terms of, or not bearish is the wrong word. The odds are very pessimistic across this Fed curve, where the Fed doesn't have to do much to really prove this curve wrong. Meaning, there's a lot of downside priced into this curve, and we've been saying this for some time. It's very likely a policy undershoot. When the Fed was pricing in 50 basis points, or when the Fed funds futures were pricing in the Fed raising 50 basis points at the next meeting, we said it was a policy overshoot. Now we think we're looking at a policy undershoot. We'll see how this plays out, though, into this week. If you guys have any questions, feel free to join our Discord. It's free. You can message us in the pit. We're happy to answer some of your questions. Thank you so much for listening, guys, and have a great weekend.